Well, good afternoon, everybody, and welcome to the mid-April 2022 Bull Sessions. My name is Mark Robertson. I am joined here by Kim Butcher. Good afternoon, Kim.
Good afternoon, Mark. I hope everybody else out in the audience is doing well today.
And we certainly both hope that all of you had a great Easter, hence the arrival of the Easter Bunny on the cover page. Ken Kabula is on the road. He was going to try to check in if he was in a place where he was able to do that. I don't expect that to happen. He had a long trip between here and Pittsburgh yesterday because we actually had 4 inches of snow. Nice post-Easter snow here in Michigan. So it's been, I think he had quite a long trip, quite a slog to get even as far as Pittsburgh. And he was doing more traveling today, so I think we'll operate without him. So welcome, everybody. We are going to spend a little bit of time with just a moment with baseball. I'm not going to go too deep into it, but just a reminder about the historical reliability of baseball. Those of you that have been around for a while have seen us and me specifically talk about Field of Dreams and the James Earl Jones speech in that movie, Field of Dreams. And today we're going to spend just a couple minutes with Bull Durham and two of the most famous quotes in movie history. One of them's right there on the cover page. Sometimes you win, sometimes you lose, and sometimes it rains. That's Bull Durham and Crash Davis's version of the Rule of 5 or the Rule of 3, I guess. And then we are going to take a look at, as I said, we do have a new leader in the groundhog. That's Ken Hebner on the left. Kathy Wood continues to struggle, so we're going to take a little bit of a look at that. Kim is bringing us this fantastic site that we have found and just want to figure out how good it is and how useful it is, called Doco. And looks pretty good, Kim. I don't know. You've been only at it for about a week, too? Just kind of
only a week. I was looking for, since Seeking Alpha put all the transcripts of the quarterly reports behind a paywall, I've been trying to find something, and I found Fool.com, but then I also found this website because I love reading what the analysts' questions are and what their answers are to see if there's anything I'm overlooking.
Okay, yeah, and they seem to do a real nice job of aggregating and providing a whole bunch of stuff. Well, I'm still passing judgment on it. I don't know that it takes it necessarily to the next level. I haven't found their analyst estimate stuff yet. It may be there, but I didn't find it yet. We'll take a look. The Driftwood is a reference to Kathy Wood and her ARC Innovation Fund that continues to keep drifting, and it's really getting a little bit old. I'd like to see that kind of bottom out and head back in the right direction. And last but not least, just your reminder that a week from today, we will have our roundtable. Our traditional roundtable will be a special broadcast involving the St. Louis chapter as a co-sponsor. Candace Baker is going to participate in it. And what we're going to do is start an hour early. It's one sign up for the entire session. We'll start an hour early. We're going to spend an hour talking about what we think of as celebrating the workhorses of our portfolios. And what I mean by that is, as it says in the banner there, flyover stocks. Because we spend an awful lot of time pursuing, we certainly do around here, pursuing the smaller companies like we do with our best small companies. And then we're naturally driven to the larger companies also. And kind of in that middle zone, there's a bunch of really fascinating stocks. And we just want to make sure we understand that. There's a reason that George Nicholson, grandfather of the modern investment club movement, recommended that your portfolio basically contain 50% of those medium-sized companies in your portfolio. And most of us do a pretty good job doing that. And sometimes the names are not sexy and famous, but they deliver nice returns, as Kim would say, ka-ching, to shareholders. So we're going to spend some time talking about that in the first half, and then we will have a traditional roundtable, again with Candace Baker from St. Louis as one of the panelists. And again, that's 1 week from today. Any thoughts on that, Kim, or can we press on?
Press on, press on.
Yeah, the Twitter birds are still on the slide because Elon Musk is continuing to kick that around. We can save that for later on or post session. Here's our boilerplate reminder. I see a lot of familiar faces. Welcome back. You know the drill, but in case you are new here, no investment recommendation whatsoever is intended, but what we do here, it is about education and specifically demonstration. Demonstrations of methods, philosophies, techniques, and beliefs of the modern investment club movement as interpreted by Manifest Investing and as deployed by us at Manifest Investing. This is a long-term investing community, and the things that we do here are our opinions. Please, please, please do your own homework before making a decision on anything that we talk about here today. If we own something, we'll try to remember to tell you. If you'd like a reminder for next Tuesday and for the monthly sessions, we have one roundtable per month. You can send an email to ncavula1@comcast.net, and Natalie will take care of you. If you have any questions about today, just send an email to markr@manifestinvesting.com, and I'd be happy to help you out. All right, so getting underway. Again, it's the beginning of the baseball season. A little bit different, started a little bit late. This is kind of a little bit of tin cup. It's more the PG-13 version of things. And this is that other quote that is actually shared by Crash Davis, Kevin Costner, with Susan Sarandon early on in the movie. And you can do your own reading. I did have to turn it into the PG-13 version. But I do want to point out that these guys do believe in the sweet spot, which is an interesting thing and something that we also believe in at Manifest Investing. And I absolutely believe in opening presents on Christmas morning rather than on Christmas Eve. How about you, Kim?
Absolutely. That's the only way my household has always done it.
You know, there's a lot of petitions in our family, especially my extended family, for, exceptions for Christmas Eve. And I'm always pushing back. In fact, I push more towards the Epiphany for the majority of our celebrations, but that makes me really weird. But this is that other quote, and it's a fairly strong one that comes early on in the movie. Susan Sarandon is a super groupie at a minor league site, and Crash Davis is famous for having approaching the all-time record for career minor league home runs. And that's cool, except in order to achieve that record, you have to fail to make what they call the show, the major leagues. But Crash Davis is quite a legendary person in that movie. And just one other slide. I sent this to Cy Lynch. We'll probably talk about this sometime, but it's kind of our baseball-driven reminder that you don't have to swing at every pitch. The person or the individual pictured here is Ted Williams, one of the best hitters of all time for the Boston Red Sox. And what you're looking at is a map of his batting average based on where the pitch was in the strike zone. And obviously the stuff right belt high in the middle is where the majority of the success comes from, is shown by those red, orange, and yellow circles. And then it kind of cools off as you go in outside and down on the lower right-hand side. If you could pitch it away from him and still keep it over the plate, you might have a somewhat decent chance of getting him out. I will point out that some of the lower numbers on this chart, up down in this range for him, low for him, is average for everybody else. So those are only average for him. He was really quite a sensational hitter. I am fairly well convinced that Cy Lynch will somehow take this picture and turn it into a presentation. So I'm not going to steal any more, but good stuff. All right, here is our version of the Ted Williams picture. We shared this just a few weeks ago, and I just thought we would do it again, especially heading into that presentation in St. Louis. I don't know if you were here for this session, Kim. Did you?
I know. I wasn't there.
Well, good. Then I feel like I'm sharing it with at least one person who hasn't seen it before. It's really kind of fascinating. Again, thinking about these medium or mid-sized companies, this would be represented by the S&P 400 medium-sized companies. Notice that they actually top out at the top of this chart, and the S&P 600, the small cap companies do pretty well, but you can see that the the medium-sized companies have actually outpaced them. And again, the recommendation from the Modern Investment Club movement is that you basically have 25% of your portfolio in these type of companies, the large blue chips, and 50% in these types of companies, with the remaining 25% coming from the smaller companies. So that 1/4, 1/2, 1/4 distribution, again, urges us, much like that image of Ted Williams, to make sure that you do have a good representation of medium-sized workhorses in your portfolio. So the numbers on the right, I kind of get a little bit dizzy, as we get many years behind us. This happens to be a 20-year look, almost 30-year look at these three distributions of companies, and breaking it down into annualized percentages. I just love this because it really makes the point of, these may seem like small differences down here, going from 8.6 to 10.5, but look where 10.5 ends up. This 1.39 thousand versus 833. Again, just underscoring that when you're talking about 20 or 30 years, 0.5% or 1% or 2%, it really, really matters. And again,
You gotta love that compounding.
Yeah, I mean, I think it's just astounding. I don't think most people would expect that the type of a large difference in the end, the sum or the result, with such a small difference between those categories, but the numbers are right there. So yeah, you got to love the compounding. Now, what's the book that you recommended on the compounding not so long ago, Kim?
Too many books.
Was it The Joys of Compounding?
Yes, that's an excellent book. I've recommended that, and Ken read it, and he was really impressed, and I think he even gave some of his grandkids it.
Yeah, it was The Joys of Compounding, The Passionate Pursuit of Lifelong Learning, and it's by a gentleman by the name, I think it's a gentleman. Last name is Baid, B-A-I-D, B-A-I-D. I'll put a picture of it, or perhaps include a picture of our library. And the first name is Gautam, G-A-U-T-A-M, Gautam Baid. And I've heard nothing but good things. I've only scanned it. I think it's in my pile of stuff to read, and that pile continues to grow as Kim sends me more and more books all the time. All right. So again, small differences can make huge differences in the long-term outcomes. And I think this is a fairly useful slide. We'll probably throw this on the screen a week from today when we're doing the St. Louis thing. Okay. Keeping going. All right, Kim. I went and I tried to figure out, where does the name DACO come from, and I did not successfully get an answer to that. Just kind of give us an idea of what you find interesting about this site. And I think what we'll do is towards the end actually just demonstrate this live. But right now, this is just to give everybody a glimpse of the benefits and the construct of the site. So what are your thoughts?
Well, I'm part of a book club, and that's why Mark is always giving everyone in the audience some new book titles, because we're always challenging ourselves to find something new. And this website was discussed in my book club, and it was because that I personally like to go to I was going to the Seeking Alpha site. I was printing out all the questions that get asked by the analysts, because they're analysts. I'm just a retired nurse. And so they may ask some questions that I may not have thought of, or something else could affect the company. And when they put that behind a paywall, really, boy, I got frustrated. And then I found out you can go to www.fool.com, and sometimes they have those stocks in there, but other times they don't. So I was always trying to find, what's my backup? And I found this site was discussed, and I'm really enjoying it because of the in-depth information that they can have on there on the quarterly reports and then all the transcripts from the quarterly report, because I like looking at the deck from the quarterly report and seeing what they follow along in the transcript and what they're talking about, how the company's doing or not doing, and what the game plan is. You know, I have a tendency sometimes to print out those questions and then ask myself a question and then find out later on as I'm listening to the call, did they answer the question, or is there something else I need to be learning? So my big thing is I really like the printout that you can get of the transcripts of the quarterly reports. As for everything else that's available, I'll be honest, I haven't had time to look at it. My plate's getting full.
Yeah, and I've actually spent a little bit of time. I tucked in 5 of the major constituents of the Manifest 40, so these are favorite companies, and I'm going to see what these are like to follow. But as you can see down that left-hand side there, there's a number of different things. Here's one for Matt Spielman. You can actually look over a whole bunch of SPAC stuff. Here's one for Sean. Reddit is right here, the direct access to it. But obviously earnings reports, all kinds of stuff. Notice that there is a mention of screeners here. I want to put it through its paces there, but here let's take just a little bit of a look at some of the other stuff that's here. And as Kim said, you know, you can access a whole bunch of the 10K and 10Q filing stuff. And as Ken has mentioned here in recent weeks, this notion of doing a keyword search appears to be enabled. Have you done any of that yet, Kim?
I have not had time for that, but I have definitely done it in doing spinoffs, because I always am looking at executive compensation, and I'm looking at to see how what are the metrics for the bonuses for the insiders, because that way it also tells me, really can give you a good idea of where the stock's going to go, because everybody wants to get paid, and if the executives know how to get their compensation, then that happens.
Yeah, no, this actually just reminded me of something that Don Danko taught me many years ago about one of the intangible ways of, or perhaps tangible ways of measuring the excellence of a company. Basically, look what they said they were going to do, and then go see if they did it. And I can remember going through an exercise with Better Investing with Colgate-Palmolive, where we basically went back and looked at, well, here's what they said they were going to do to reconfigure and reshape the product portfolio 5 years ago, and here's what happened. And that is kind of, you know, and obviously if there are changes, you want to understand if there were any detours or that kind of stuff, see what their explanation is for that. But really neat stuff, and this would appear to support and enable that sort of thing. Here's another one that I think really fits some of the stuff that we've been talking a little bit about. Kim has been pushing me to do more with electric vehicles and batteries, and Ken has had a number of discussions at his investment clubs and the model clubs here in Michigan. But this actually demonstrates that, you know, talking about going in and looking for related companies that are related to things like blockchain or lithium. And this isn't where you discovered your Nevada lithium company, right?
No, this is not it. I have developed it. At any time I would travel or go anywhere, I would ask the person sitting next to me, because I have a BI magazine, and say, oh, are you here traveling for business or pleasure? And if it was business, then I would ask them what their business was. Then I'd pepper them with questions. And I can't even think of it. What was the name of that stock, Mark, that got bought out by Phillips? The healthcare stock. Well, that's how I found that healthcare stock.
Probably biometric, biotelemetry.
Yes.
Yeah.
Biotelemetry. That's how I found that stock. So, you know, I have a tendency to talk, I've been told, to anybody. And I ask them, you know, what are you buying? What are you interested in? Why are you interested? And I talked to one of my friends, and ultimately they came around and said, well, you ought to look at this, because the engineer of this business started and worked with Tesla when they built the Tesla factory, and now he has won a competition and has contracts, I believe, with the Department of Energy for recycling lithium and recycling EV batteries. So I did my due diligence, and that's how I found out about the stock that I'm following now. That always, someone may have a stock that you've never heard of. So ask, what are you looking at, and why are you interested?
Mm-hmm. And I think this actually streamlines that a little bit. One of the things that Ken and his model clubs love to do is to take a theme and then drill down and try to find obscure companies, promising companies. And this would appear to enable that. So we want to kind of watch this and see if that will be supported fairly effectively. And they also have an ability to generate financial graphics and that sort of thing. I played with it a tiny bit, but there's much more that I need to do just to figure out exactly how much can be done. I'm just kind of curious as to whether or not I can generate something like an instant stock selection guide. So stay tuned. Here's just the really quick stuff I did. One of the things we've talked about is Superior Group, one of our best small companies for this year that is kind of lackluster, but a lot of hope for the future. Here, I just threw this one together in a matter of 15 seconds just to get a look at it. And you can see, I think this is one of those companies that benefited from the COVID bump up and settling back into more traditional trend of business. And that can be quite a challenging, and it can be a bit of a trap, as we're noticing with a number of companies. So we want to be aware of the trap nature and the opportunity nature for companies as they restore back to the longer term trend lines. Reversion to trend. I'm not sure we believe in reversion to the mean, but we do believe in reversion to the trend. All right, so we'll take a look. We'll spend a couple moments kicking around on that one at the end of the session. Again, I was going to put this in the appendix, hopefully, getting a little more stability at the top, and then lo and behold, we have a new leader, Ken Hebner of the CGM Mutual Fund, has taken over the lead. So we're going to spend a little bit of time talking about that stuff. But again, Kim and I are not on here yet. So Kim, you're not too far off, but Ken and I are kind of percolating down there around number 60, I think. And
that means that we don't want to be a flash in the pan and go out too soon.
Well, yeah, we want that dramatic close at the end, or
we just, truthfully, considering I have a tendency sometimes, last couple of years, I'm picking flyers, and the flyers have been duds. So
yeah,
hopefully this year I'll be at least in the top 100,
Yeah, anybody who swung for the fences this year is definitely feeling it, along with Kathy. Kathy Wood, as you guys know, was one of our two benchmarks here that we look at as an indicator of what's going on. She recently went from 150th to like 70th, and now she's back at 162nd. And I'm not sure she's got much farther to drop, and I'm ready for her to turn around. Again, a relatively small number of us are beating the market, and it's here that I would like to dwell on the words of K Light. It's early. Don't obsess too much. The average return is minus 4%, but we are seeing an awful lot of clubs bubbling up the list. It continues to look like that, and we'll see. So let's talk about Ken Hebner. Ken Hebner is a two-time winner of the Celebrity Groundhog component of the contest, and you can see where the two wins were. They're pretty obvious on here. The performance of his fund back in these two time frames are when he actually won the celebrity contest, and but his performance over the long term has been fairly spotty, and Morningstar is pretty unkind to him. You can see that here's the performance since Groundhog Day. Here's Groundhog Day on the chart right back here, and this produces that 16%, 15 or 16% difference that puts him in the lead right now. How's he doing that? Well, here's a couple of things. Here's a look at the performance of the CGM Focus Fund over the last 10 years. You can see here's the lackluster part, 6.8%, trailing the market by 8 percentage points. He's actually had $2 billion in fund outflows over the last few years, and he still has half a billion in assets under management. That's just one thing we wanted to point out. The other thing that I find compelling, bit of a nudge, is his portfolio has this substantial projected return on value, and that's after the run-up. And I want to scratch my head over that and see what it tells me. You can see of all the funds on this list, he's the only one that is hot with a relative strength index of 68. So he's been crunching along pretty good. The other thing I wanted to show on the chart is I didn't believe that Cathie Wood and ARC Innovation would fall down the list as rapidly as they have, but in the last quarter they've dropped from number 1 down to number 13. So they're there. So what is Hebner chasing? What's he investing in? You can see that Morningstar is pretty unkind. That's actually Morningstar ratings. But here are the top 20 holdings, and notice when it's called a focus fund, those 20 or 25 holdings, I'm not sure how many you're showing there, probably 20, represent 98% of total assets. So you are looking at basically the entire fund. And notice some of the stuff going on here. First of all, look at some of those robust projected return on value numbers right down the middle. But here's CVS. There's a number of building-related stocks. Prudential, I know a number of you probably caught Prudential. Along Kim's Chubb was one that has benefited lately on the insurance sector run-up. There's a number of builders. There's a number of discretionary retail stocks in here. There's Buckle, which ended up at the top of our update list this week. There's a number of companies like FANG, which benefits from the Permian Basin energy situation. So it's a little bit unconventional, but that's basically how he's put it together.
He's got some banks in there too.
There are a number of banks in there. And
Wells Fargo, Bank of America.
A number of builders. Be interesting to watch what he does here, because the other thing that I would pose as a question to everybody, or at least as a theory perhaps, he seems to ride these waves up, but when the market takes off and has a moment, as it did here, and it certainly did here and here, his fund has actually kind of indicated that in advance. So I think I'm going to add the performance of the CGM Focus Fund into things that I watch, and if this begins tailing off, it might be yet one more indicator of be careful out there and ratchet up quality and perhaps ratchet up cash equivalents. But just throw that out there as maybe I'm imagining things, but it seems like he does find that stuff that when it comes unraveled, it unravels pretty significantly. All right. A couple of slides that kind of capture the spirit of things we've talked about in recent weeks. The lockdowns in China are intensifying. So I'm pretty glad that we're out of green tree hospitality for now. And when it comes to the best small companies. But the thing I wanted to share is just this notion of, in fact, it ties back to the slide just a few slides ago on lithium. Rivian came out, the CEO of Rivian came out and said that the chip problem, the chip delivery and shortage that we have for automobiles is basically going to look like child's play to what happens with batteries over the next 10 years, 5 to 10 years. And so that's something to consider. A well-positioned battery supplier is probably a virtue. It's something Kim has been pushing us to think about, and maybe we try to exercise DACO and unearth opportunity in that realm. I mean, it's certainly not the early stage of the bandwagon, but who knows what we might find if we actually dig in and try to position ourselves for that. Your thoughts, Kim?
Well, yeah, things are going to change. It's not going to be all vehicles are going to be with carbon emissions, and it's all seeming to go to batteries. And so with batteries, I've as Ken talked about, you got to have chargers, but you got to have lithium. So then I was trying to find out as to who's got the best story on recycling lithium batteries. And there's all kinds of chemical breakdowns that are really bad for when you break down those batteries. And it made me search to find as to which of those companies out there are good and safe for the environment. So I think it's a great way to go down, and it, as some have said, you're doing it before it's happening, so you might be getting into some penny stocks, and it's one to watch and see what's going on to see which one's going to rise and percolate to the top, which will be the best one. Because I know there's, I think, 2 to 3 companies out there who used to have executives at Tesla that are in Nevada talking about doing recycling of batteries.
Certainly an area to learn a little bit more about. For more on the Chinese lockdown and some of the supply side disruptions, you can check out that link. But I thought I would toss out just as food for thought. From the roundtable back about 7 years ago, Ken and the audience selected PriceSmart. It was a great presentation, made a whole lot of sense. PriceSmart is basically the Costco or Walmart of Latin America, as I understand it. And I might be overgeneralizing there or missing the boat by a little bit, but that's basically the type of business that we're talking about. That all kind of makes sense to me. And I'm just kind of throwing out there the what if. What if this notion of, emerging market supply chain disruptions actually came to pass, and this stock was impacted much like it would have been impacted here. Notice that the price actually went down to $41.20 during that. It's actually gone up 100% in a little over the last year or so. This is a pretty solid company. I just throw it out there as something that has been basically vetted. If you go back and listen to the rationale behind PriceSmart and its field of opportunity, that is still intact. What if it gets hit by supply chain disruptions, and it basically has been in this flat spot for a long time. With that one excursion way down. And then I would also point out, anytime you're looking at a retailer like this, notice that the number of stores actually kind of tapered off and plateaued also. But when you look at their plans for the next few years, it actually is resuming a bit of a growth trajectory. So is there opportunity there or not? And I'm just kind of throwing this out to the audience. If you find a company that you think fits this mold of being potentially vulnerable to a supply chain disruption, yet is a fairly solid business that could basically come out of it and emerge with a really nice period. Notice again, it went from 41 to 104 in a fairly short order on the value line chart. So just throwing it out there as a nudge and food for thought. So good, clean fun. And again, Ken, we have actually walked away from this position a few years later after this flat spot seemed to press on, but certainly is the type of company that would be welcome back at the round table at some point in the future. All right. Last week we talked about these 10 companies, and I promise you I'm going to go in and search through our stuff using some of our metrics, similar metrics, but we talked about how some of these companies were still fairly new, and in fact 3 or 4 of them were uncovered by Manifest Investing. So we do want to take a closer look. This one continues to look compelling to at least be aware of and have it on the radar screen with the stuff that they are attempting to address and find solutions for. Kim, did you have any familiarity with Evotech?
I do not. So, I'm writing the initials down now.
Already going to work. Maybe we pull that one up on DACO and see what it looks like. But
sounds like,
again, yeah. Very profitable companies, some of them very early stage, as Kim was just saying. So you have to keep that in mind also. Some would have to be certainly thought of as speculative. but these are profitable companies. So notice that NVIDIA is in this group. So one of the things I did over the last week is went in and made sure that they are all covered at Manifest. So when we push the button and do this week's update, all of these will be available for dashboards. And here's just a quick look at some of the points of view that we find most informative. Remember, we talked about I guess it's Adyen last week. Some fairly decent numbers there. Look at the numbers for Evotech. Again, a 20% growth rate, decent profitability. This probably goes up if they're successful in the things that they do. Decent return projection, middle of the pack, maybe slightly below average projected return on value. A number of these are in the lower relative strength index realm, but fairly decent numbers with respect to the Morningstar price to fair value and the analyst consensus price to fair value. And then again, some of these have elevated one-year expectations that might be worth understanding or exploring a little bit more. But again, some of these are probably worth taking a little bit closer look at. I was impressed that D-Local, I had no awareness of this company, actually has some pretty good numbers across the board. And even as it matures and becomes a little bit larger, looks fairly promising. The Stoximity also, I had no idea that company was DOCS, DOCS, the ticker. Again, some fairly decent parameters there. And Datadog, another one that is actually in a number of groundhog portfolios. So some of you are shopping using techniques similar to this. But again, this Evotech kind of caught our attention. Probably want to keep track of it. And it falls into the specialty and generic drug manufacturers. Any surprises on there, Kim, or companies that you were less familiar with?
Oh, probably 50% I've never heard of. So yeah, it's always good. I think it's interesting also to see that you have software application, software infrastructure, software infrastructure, software application, infrastructure. So certainly is an area that we need to make sure that we're aware of.
Yeah, and the one on here that is not a surprise to anybody, it's in Value Line, so it's in the standard edition, but that's a cybersecurity software company, and that secret's out. I mean, it's not a secret anymore. A lot of people know about it. Projected return low, fairly low value line number. It's one of the hottest ones on here. So no surprise there. That's obviously an area that's been pursued a lot here in the last year. So we'll do a little bit more. What I will probably do is take a very similar metric like Prove by itself or something else along those lines and go in and see if there's any other companies that pop up using either the Manifest database or Y charts to and DACO as we dig deeper into that. All right. Quick moment with our best small companies. Again, we continue to struggle, but we're doing better with the traditional portfolio than the Russell 2000. Just shows you how severe we're actually in a bear market. In the Russell 2000 Growth Fund, that's an ETF that you can buy directly. Our traditional buy and hold, the same stocks from Halloween to Halloween, is outperforming that, but it is not keeping up with the market, which is down, but not down as dramatically as the smaller growth companies. You can see that we've done 2 transactions replacing eHealth with Pachira Biosciences, which has been a very welcome addition to the portfolio. We sold Green Tree and added First Foundation. And we don't put a full position in. We basically take the proceeds of sale from Green Tree and then invest that in First Foundation. And that's just hopefully going to stabilize. And again, we're trying to avoid that Chinese lockdown and disruption that continues to persist over there. So that is the status of those right now. We continue to hope for better. Here's a look at the dashboard just to make sure that there isn't anything drifting too far off course. I'm not sure what's going on here. That's probably a matter of very sparse analyst coverage and somebody changing their mind. I'll be taking a look at that after today's session to see what might explain that. But from top to bottom, treated in aggregate, pretty decent growth rate, reasonable PE, good characteristics for these type of companies, and I think it's well positioned going forward. A number of these are in my portfolio already. I do have some Boston Beer, some Medifast. I know Ken has been really high on Car Gurus. It's turned out to be one of our better ones. And just a number of companies on here that are quite promising. I think Green Brick Partners is quite promising also.
Yeah, I have Southern Missouri Bank Corp.
Mm-hmm.
I put my toe in the water, and I like that it's dropped so I can put another toe in.
All right. That portfolio is always available at that public link up at the top of the page. All right. Just a reminder that we are going to get into this one sometime in the not too distant future. Just a quick reminder that we'll be doing our own little mini book club study on this one. I have noticed that our Morgan Stanley counterpoint funds have actually taken quite a hit here with this latest downdraft in the market, and that's where Michael comes in, because he is influential in the Morgan Stanley counterpoint funds. So a little bit of luster knocked off the situation there. Then I also wanted to share, this is a new one to me. My pile keeps building, but this one I'm going to get into because I've met Nick. I have a lot of respect for Nick as he's a Stanford economist. He is the information officer at Ritholtz Wealth Management, and I'm hearing lots of good things from people that I respect. Your book club hasn't chunked into this one yet, have you?
No, we have not. I'm writing it down. No one's mentioned this one at all.
Yeah, he's got a real down to earth, and the thing that I really like about it is he basically takes some of the things that are, and I'm using air quotes here, known in the financial and investing industries, and demands that it make sense or stack up with respect to evidence-based stuff, and that's right up my alley. So I want to take a look. The other thing is it's basically recommended. These don't come cheap, and by cheap I just mean personal integrity here. 3 people that I've met and I respect: Jim O'Shaughnessy, Christine Benz, and Morgan Housel. Basically are endorsing the book, and if it's good enough for the 3 of them, I got to read it. All right. So that one is likely to become food for a future topic, future discussion, not too far down the road here. All right, here's a reminder that we do archive all of these sessions at Manifest Investing on YouTube. And this is just simply a reminder that you can access the COVID cancellation conferences, the successful investing special sessions using the playlists. And again, if you're not subscribed, the benefit of subscribing is, one, it helps us and helps us with the YouTube algorithm, but also you become notified. You are notified of any time that new content is added to the site. And that can be a bull session or a round table or a special educational session, and all of the above. Right, and here's your reminder that a week from today, we are going to have that special session in cooperation with the St. Louis chapter of Better Investing. And we look forward to that. It'll be a lot of fun. St. Louis is one of my favorite places. You see the riverfront there. So any comments or questions, Kim?
No, none for me at all. I know that in the question box there was Robert Kellogg has given us a lot of information that, interesting enough, Starbucks is no longer showing China in its 10 Qs, but it does show Asia. It's going to be interesting for all the companies when they start reporting out if they had any investments into Russia. How also he was discussing as how will Airbnb do, since there's a lot of communities that are restricting them, especially the gated communities and homeowner associations.
Yep.
So
be a good question to ask via DACO and see if the analysts have actually dealt with that. Be a good thing to explore.
Yep.
All right, so with that, what I think I'll do is shut down, and we can stick around and play with DACO a little bit, maybe.
Sounds great.